Hi, Magda and Steve. Thank you very much for joining us today, and thank you for accepting my invite to participate in our global research. I think before we start, maybe you can tell us a bit about yourself, your background, and your role at Willis Towers Watson.
Yes, happy to start. So I've been at WTW for 17 years. I currently lead our Insurtech innovation efforts in EMEA. And I've been working in the Insurtech space for almost a decade. So it has been a nice journey, interesting one.
Hi, Gail. Steve Bluemenfield, run partnerships and alliances for WTW. Have been with the company just shy of 30 years now, on and off, with some other things we did in the health insurance space. I ran strategy and innovation for our health and benefits business, where we focused on Insurtechs in the health space, as well as other startups in that space for a good number of years as well. So I'll focus a little bit more on that part of the equation.
Amazing. So basically, you both have seen the 2008 collapse, and you've been there even before. I would like to start with a simple question about the current state of insurance industry in regards to the valuations that we see of the Insurtech companies, the market sentiment, which is going very bad. And the question is, are we sobering, or this is temporary? How do you see this situation?
Well, I like to be very controversial on that. In the last, I don't know how many panels I was, people were like, well, we have to look at valuations, everything is going down. Usually what I would say is, I'm an economist. Part of my PhD was on financial crisis and how sentiment can aggregate. And I feel right now, if I look at Insurtech companies, and if you look at every one of those specific companies that are losing value in the market, all I can say is the market is not differentiating. There is a high correlation on what's going on across tech companies, not only Insurtech companies. You have very different companies, all following the same trends of the market, very much driven by sentiment, not necessarily by fundamentals. A lot of the capital that went into those companies really don't understand the fundamentals of those companies or insurance as an industry, and there is no differentiation in the market. So, as in other cases before, it's always difficult to tough it out, right? Because you have to tough it out while it lasts. But I think there is a lot of, sentiment leading these type of events, and not necessarily that these companies don't have the right foundations to succeed. If you look at them individually, if you look at their ratios, if you look at their evolution, if you look at their technology, if you look at their growth in the markets they're going after, if you read their strategies, fundamentals are strong for many of these companies, despite what the market is reflecting right now.
Yeah, I'm going to say that at least for what I've seen in the health sector and some of what I see in the Insurtech sector more broadly, valuations were driven by a lot of cash being piled on by some late market entrants that decided that this gravy train was going to continue into IPOs and SPACs, and they were gonna make their money back. You've seen some of those big companies with big write-downs, actually. So, when large investment houses, large VCs actually write down their own expectations, that says something, right? Because there was so much free capital, and that's how it was referred to. A lot of the startups work with said, there's free money right now, so let's get as much as we can while we can, because when that happens, there isn't as much pressure immediately on performance. What I'm seeing is those investors sitting by, they've got a lot of dry powder, there's a lot of money out there, but waiting to see who actually performs, and that there is some pressure mounting. Over the last few weeks, a couple of months, we've seen actually 2 or 3 companies, again, in the general health tech space fold or sell off some of their parts. So I do think that we are seeing maybe a tempering of valuations and the likelihood that, companies will be tested. I don't think we're quite at a point right now, but I think if we look a year out, we're going to see, some companies have actually folded or have sold off their pieces or have down rounds. And I think 2 years we'll see a bit more of it. But again, my lens is a little bit more skewed toward the health side.
And if I may add to that, Gil, essentially every storm has a cleansing effect, right? It really it sucks for those that don't make it, but I don't think a storm where there is more scrutiny is a bad thing. And obviously, if you're in the business of having an investment fund on Insurtech and you're losing 30% of the value of your portfolio because of this, then you realize that some of those companies probably shouldn't have been there in the first place. Right. But the cleansing is a good thing. It's really difficult for industries to iterate quickly and to really bring innovation to the forefront if the waters are too polluted. So that's my 2 cents on that.
Yeah, I completely agree with this. So I'm just having a small additional question because I completely agree with what you both just said. When do you think we are going to start reflection of the good companies going back to normality in terms of valuations? Do you think it will take us a decade, 5 years, 2 years? How do you see it?
Boy, that's a tough one because we're already seeing. Sorry, there's a dog barking. Of course. Wait, Magda, maybe you should go first.
Yes, I'll go first. Go on mute. I wish I had the answer to that, Gil. I get it. I get asked that question a lot, actually. And if I had to just bet on it, right? Probably my answer would be around 2 to 3 years, because of the type of companies that are being cleansed out in this type of storm, right? And the ones that need to show how their fundamentals are playing out, they will need some time because of the moment in their evolution, right? If you look at things like historically, I don't know, the races of lemonade, which have generated too many headlines. From the beginning, they had a long-term play. From the beginning, they knew that they were going to iterate in a certain way. And sometimes, it takes time to show the fundamentals. So for the larger companies where I believe there will be success, where I believe fundamentals are strong, they still are 2 or 3 years away from being able to show how their strategy, which is radically different in the sense of how they're building the channels, how they're deploying the product, how they are accessing new markets, plays out, because iteration takes time. So right. I think for those, it's probably 2 or 3 years. That means also that in 2 or 3 years, there's a number of companies that will disappear and there will be value destruction. And that's okay. But I don't think it will take us 5 to 10 years, because it's once it kicks in, it's very quick in the way it actually displays the true difference in what they are doing and how that strategy and value is playing out. So to me, it's a 2 or 3 year thing, and it's a good moment to actually look at these companies and buy, yes. Right? To my taste, some valuations still aren't low enough.
That's right. I think that timing is nice. It feels like that's around when we're going to see maybe this come to roost. You asked when it will return to normalcy, Gil. I don't know what normal was. We had you might say that right now we're at normal and it's got some downward movement to go still, and then it's going to come back again. Maybe the market itself comes back again in 5 years. But I expect that companies who are going to go IPO or go for additional rounds they're going to have lower values than they had before for the next couple of years. I think we're going to see it creeping back into the IPO space when they think they can make their money, but then some are going to realize, we're just not going to make as much back. So in a couple of years, I think 2 years from now, if we have this interview, it'd be really fascinating to see if we're seeing Probably not the entire market there, but some really strong examples of what we just explained. And I would bet, 5 years from now, we're probably close to normal.
Yeah, I agree. I think that it will take some time to grow back to your valuation. And as fast you grow, sorry, Magda?
No, I was just going to say, but the good thing is, while you are waiting for that valuation and expecting a better exit, right, you have to build stuff.
Right.
Because you can't just sit on what you're sitting, right? And all of these companies have entrepreneurs behind them, and they are building stuff. They are reinventing. They're pivoting to more traditional channels, as we've seen. Like, if you look at WeFox evolution, it's an amazing evolution in the sense of how they evolved. If you look at MGAs in Germany, well, they went from niches to niches for traditional products, from digital only to digital plus traditional channels. So I feel, while these companies might wait for a better exit, they will probably continue to add value and to evolve the space, and therefore those exits will not only be good because the valuation went up based on sentiment, but it also will go up based on the fundamentals that they are building. So. Exactly. I think this is a good environment. I understand that when there is value destruction, people get very nervous, but this is a good environment to push forward those solutions that truly are doing something different.
I could completely agree. So this leads me to my next question. You see so many companies all around Europe, the US, etc., in all verticals. How do you consider to be? What do you consider to be the major 2 or 3 trends in the insurance industry for the next years?
Okay, so I'm going to go with my favorites. I think, persona augmentation. And when I say persona, I mean the underwriter, I mean the claims adjuster, I mean the end customer, I mean the seller, I mean the agent. So everything that is augmenting decision makers with better data and advanced analytics. That's an area we have seen take off. It is strong. It will continue to strengthen. We have to figure out things around data infrastructure, around data centralization models, around open data, and around industry specific advanced analytical tools. Like, for instance, I don't know, we just patented a new type of algorithm in the context of a GBM, right? Which is specific to insurance. So I think that's an area that will continue to flourish because it adds value and it's necessary. Then a second area has a lot of headlines. I'm not going to be very original here, is embedded insurance. I have a different flavor towards embedded insurance. I think embedded insurance is not about selling commoditized microinsurance type of products like mass insurance through alternative channels. It really it adds value when those products become dynamic, modular, and actually can be reconfigured, because otherwise you cannot use transactional data to leverage the value of that different type of channel. So I think that's a second area. And, the third area really has to do with new types of risks and risk assessment. And that's a combination of new data sources, but also new ways of looking at risk and combining not only the risk transfer, but, the resilience building angle. And that is true in the context of ESG, but it's true in the context of a lot of new political risks we're seeing. So to me, that's another area that will continue to trend. It still needs consolidation. Right now, it's all over the place. I have an index for this, I have an index for that, I have a data source for this, I have satellite, I have LiDAR. I don't know. That needs to actually become something that really is looking at interrelation of risk and new risks in a more cohesive way. But to me, that's the third area that will continue to deliver value.
No, I think that's really, really well said. I would just add that this maturing and specializing of new types of data and technologies that enable risk to be revealed and reduced, and then insurance to be written, whether it's parametric or whether it's just a deeper understanding against the underwriting. I think that's a big trend as well.
Wow. Yes. So we're talking about a lot of data from all around the world and all the resources and sources.
Yeah, and I think we shouldn't forget about the data tools that are out there. I mean, probably a bunch of folks will take the opportunity to talk about generative AI, Chat GPT, and the type. And of course, better tools that, adapt over time to be able to make better use of that data are going to be a great key. We're going to see a lot, just because there's so much activity and money being spent there. I think we'll end up seeing a lot of solutions on that platform, and we'll see what that does. It's very early days.
This expedites everything, I think.
Yeah.
Yes, but it's not only about the availability of data and the way the tools we have to analyze it. It's also, we need to look at data as data economies, and the way data infrastructure is changing, the way data ownership is changing, the way certain trends might not be sustainable if we continue to to look at data sources. Data is being generated in different places to where it's being analyzed, in different places to where it's being leveraged from a business model perspective. So the sustainability of those data ecosystems that can be closed or open, but can also be centralized or decentralized, and those four things coexist, will push the way we actually analyze the data, going into things like edge computing, federated learning, the ability for people to be custodians of their own data. So I think I wouldn't call it a trend, right? But it is what we should be looking at from a horizons and sustainability perspective of what we're building, because data infrastructure and data ownership should be reviewed, should be governed, and could be game changers in the way we do things.
Just one small question. Going back to your trend about the embedded insurance, do you think that this is the right timing for embedded insurance to move to the next level of much bigger premiums, which are much more complicated, or not yet?
It depends a lot on the player that is playing the channel part, and the player that is playing the product development and provision part. Because the only way for you to move into more complex and an embedded channel perspective is if you have a high sophistication of digitization in your product, not because it's on a digital channel, but because of the way it actually is generating data. Right. So I am 7 minutes late to something to Stanford, where we, it's part of the discussion. Digitization is a journey that has a lot of complexities, because you need rich data objects to generate data in the right places so that you can analyze it. So if we want to go into that complexity, and we want to move towards more dynamic products and dynamic underwriting, we actually need the right product construction and the right data generation. And I don't think most players are ready for that. So yes, that's my answer. We are really trying to push the market in that direction, but it needs development. Some front runners will be able to do that. Most of the market, probably not yet.
Fantastic. I really would like to thank you for your enlightening interview. And this was fantastic for us. And thank you very much for your time.
My pleasure. Cheers,
Always
Gil.
a pleasure, Gil. Thanks so much.
Bye.
Thank you very much.
Bye.